Hey traders! Have you ever entered a trade at a perfect breakout, set your stop loss, and then bam, the market reverses, hits your stop loss, and leaves you with a loss? If that sounds familiar, you've likely fallen into a trap trade. In today's video, we're diving deep into what trap trading is, the types of traps in the market, how to avoid them, and most importantly, how to use them to turn losses into profits. Stick around till the end to become a smarter, more profitable trader. What is trap trading? Trap trading happens when the market tricks retail traders into entering a trade, only to reverse and hit their stop loss. Imagine this, you're looking at a 5-minute chart, and a strong resistance level gets broken with a big green candle. Excited, you enter a buy trade, placing your stop loss just below the resistance. But within minutes, the price drops back below the resistance, triggering your stop loss. That's a false breakout, also known as a trap. These traps are often set by big players, think banks, hedge funds, or institutional investors like fees and dice. These market giants have deep pockets and use their capital to manipulate price action, creating false signals to trap retail traders. Why? Because their profits often come from our losses. When retail traders buy at a breakout, these players sell, grabbing liquidity and pushing the market in their favor. Why do big players set traps? Let's break it down. Suppose the market is at a resistance level and the price needs to drop. If both retail traders and big players sell together, the market would crash to fast, leaving no buyers to balance it. Markets need buyers for sellers to profit, right? So, big players create a false breakout above resistance to lure retail traders into buying. Once enough buyers jump in, creating liquidity, the big players sell heavily, driving the price down and pocketing profits while retail traders' stop losses get hit. Their motto? Buy low, sell high. And they use traps to make it happen. Types of traps.
There are two main types of traps. Bull trap. The price breaks above a resistance level, making you think a bullish rally is coming. You buy, but the price reverses and falls, hitting your stop loss. Bear trap. The price breaks below a support level, signaling a downtrend. You sell or short, but the price shoots back up, trapping you in a loss. For example, look at a chart where a trend line breaks after a long uptrend. Retail traders rush to buy, expecting the rally to continue, but the price crashes, wiping out their stop losses. Another example, a W pattern forms and the neckline breaks, prompting buys. But a massive red candle follows, hunting stop losses. These moves often scream big player activity because only they have the power to create such sharp reversals. How to identify and avoid traps? To outsmart traps, you need to focus on volume. It's your secret weapon. Here's how to use it. Step 1. Add volume indicator. On TradingView, go to Indicators, search for volume, and add it to your chart. It works on both mobile and desktop. Step 2. Analyze volume for breakouts. Real breakout. A breakout candle should have high volume, followed by a retest with low volume weak sellers. Then, a strong green candle with high volume confirms the breakout. Enter a buy trade and target the next resistance. False breakout. If the breakout candle has high volume, but the retest candle also has high volume strong sellers, and the next green candle has low volume, it's a trap. Sellers are dominating, so consider a sell trade when the price breaks below a swing low.
For example, in a nifty 5-minute chart, a resistance breakout with a high volume green candle signals a real breakout. You can enter a buy trade and ride the trend. But if the breakout candle has low volume and the retest candle shows high selling volume, it's a trap. Avoid buying and consider a sell. Key levels where traps happen. Traps are common at these levels. Previous day high or low. Breakouts here often fail. Opening day high or low. Early breakouts can trap early traders. Swing lows in uptrends. Fake breakdowns at supports are common. Psychological levels, numbers like 24,000 or 25,000 attract traps because big players know retail traders watch these levels. When a candle breaks these levels in one swift move, it's often a fake out. Indian markets thrive on stop loss hunting, so trade these levels cautiously with tight stop losses. Pro tips for trap trading success: wait for confirmation. Don't jump into trades without confirming with candle patterns or indicators like RSI or MACD. Check volume. Low volume on breakouts screams trap. High volume on retests confirms real moves. Risk management. Never risk more than 1-2 of your account per trade. Always use a stop loss. Stay updated. Big news like RB policies or US market events can trigger traps. Stay informed. Be patient. Trap setups don't happen every day. Wait for the right opportunity. Start small. If you're a beginner, trade with one lot until you master the strategy. Trail your profits. If the trade moves in your favor, trail your stop loss to lock in gains. Outro trap trading can be a game changer if you master it. Practice these strategies, stay disciplined, and turn those traps into profits. If you found this video helpful, smash that like button, subscribe to the channel, and drop a comment below with your next topic request. Let's keep learning and growing as traders. See you in the next video.